Hey, what's going on everyone? It's Griffin here, and with a lot of new home buyers looking to finally acquire a first property over the next couple of years, considering real estate values dropping, well, I wanted to make a video going over 10 critical elements to consider when purchasing a property of any kind. Now, these are all things I've personally come to learn and understand by buying and selling roughly a dozen properties over the past 4 years or so, and hopefully will allow you to learn from my experiences and mistakes so that you can start ahead of where I did. If at any point in today's video you do find value, please take a second to drop a like. It really helps the channel out. And I also wanted to mention that none of these are in particular order, and they apply both to buying a primary residence just as much as they apply to purchasing a rental property. So with that said, let's get into the first element. All right, so straight off the bat, we need to speak about mortgages, because chances are if you're watching today's video, you're not necessarily in a position to purchase your next property with all cash, that is without utilizing a mortgage loan. And really there are many different types of mortgage loans available, but the most common and popular are the fixed rate mortgage as well as the variable rate mortgage, both of which are available in Canada as well as the United States. The main difference between the two countries is really the fact that in the United States, usually speaking, the mortgage term will be either 15 or 30 years, where the interest rate could be fixed and locked in during that 15 or 30 year period, whereas in Canada, typically speaking, even if say your total mortgage is over 25 years, every 3 to 5 years, your mortgage term will be up for renewal, where the interest rate as well as the terms are going to be negotiated and updated. So obviously it's really important that you fully understand the main differences between these types of mortgages for when you're looking to purchase a property, so that your decision can be strategic and in line with your goals for that given property. For example, during the height of the pandemic, when fixed rate mortgages were hovering in and around 2%, depending on how long you were taking the mortgage out for, unless you were planning on selling the property in say the next 5 years or so, well, taking out a variable rate mortgage at the time, even though the rates were lower, because typically speaking, variable rate mortgages will have a lower rate at any given moment than a fixed rate, well, you were exposing yourself though to the impacts of interest rate fluctuations, which is really now coming to bite a lot of home buyers that took out variable rate mortgages, and now that is highly impacting their monthly budget. So in my experience, variable rate mortgages are generally going to be a better option for rental properties because you're able to break out of those loans, meaning either selling or refinancing at a higher rate without incurring hefty fees and penalties that you usually have to pay with a fixed rate mortgage if you choose to break out of it, again, either selling the property or refinancing it. And so in this light, even if rates end up increasing, granted that you've taken these rate increases into account in your calculations, the tenants are the ones that are going to be paying for these higher interest payments anyways. If you want to learn more about the different types of mortgages and their impact on monthly financing costs, I'd highly recommend that you either speak with a professional mortgage broker and or watch this video that I've made on the channel that covers property affordability, mortgages, and runs many different scenarios to get you up to speed with the topic. But what's certain is that you absolutely need to understand the basics of mortgages before purchasing your first property. Once you're familiar with mortgages, well, we now need to actually apply this information to your own monthly budget to determine whether or not this given property makes sense financially. The absolute last thing that you want is to become house poor, where your monthly housing costs are exceeding 30% of your monthly income. The reason why I'm mentioning this is because a lot of first-time homebuyers are getting really excited about seeing overall real estate values dropping across the market and throughout headlines, but fail to understand how this is mainly triggered by interest rates actually increasing, which translates over into month-to-month financing costs that are actually quite similar to a property that you may have purchased a couple of years ago at a significantly higher price point. And again, I'd highly recommend watching the home affordability video after watching this one to fully understand how mortgage payments are impacted by interest rate fluctuations. This sounds really counterintuitive, but a $500,000 house, let's say 2 years ago, but at a 2% interest rate, 20% down over 25 years, represents a mortgage payment monthly of around $1,700. Fast forward, say to today, let's just say in theory that property is worth $350,000 and you're purchasing it at that price point, but at 5% interest, everything else equal, the monthly mortgage payments are actually the exact same by around $50 difference. However, you're paying way more in interest than principal on a monthly basis. And a couple other things to consider though in your monthly budget for your housing costs include the following. So financing costs, of course, insurance, municipal taxes, utilities, maintenance, and potentially other costs like water and garbage, depending on where you're purchasing. Now, ideally, if you're purchasing a rental property, all of these expenses expenses should have been accounted for ahead of time in your return on investment calculations. But if you're looking to purchase a primary residence, seriously, don't overextend yourself and stay within your budget, meaning all of these costs should stay below 30% of your monthly income. Okay, now you may have heard of the concepts known as a seller's market and a buyer's market. The main difference here really just has to do with where the supply and demand curve sits at any given moment. In a buyer's market, there's way more supply than there is demand, meaning buyers have a lot more leverage in the negotiations for the transaction. On the flip side, in a seller's market, like we've been experiencing over the past 3 years or so, it's the complete opposite, where there's significantly more demand than there is supply available in the market, meaning buyers have a lot less leverage in the transaction for negotiations and are often competing against many other very motivated buyers, all of which is beneficial for the sellers. I'm mentioning this because market environments really dictate the level of negotiations possible between buyers and sellers, and I've seen this change firsthand over the past several years of being a real estate investor. Quite simply, an offer is a proposed legal contract between a buyer and a seller, so everything within it is negotiable, from its price to closing dates, inclusions, exclusions, inspections, warranties, and so forth. In the height of a seller's market though, any type of negotiation is pretty much out of the question because there's just so much demand, right? So people were buying properties way over asking, without inspections and without legal warranties, all of which come with potential pitfalls and consequences when and if something takes a turn in a different direction than what the buyer was expecting. Now that the market is cooling off though, while negotiating in inspections, warranties, and potentially even negotiating on price point is something that's surfacing once again. So while everyone else is being fearful and running the other way, well, in reality, purchasing a property during a buyer's market is actually significantly more beneficial to us, the buyers. When most first-time homebuyers look to purchase a property, the first thing that typically comes to mind is the down payment, which does make sense because this is, generally speaking, going to be the largest expense incurred. At least it should be. That said, it's important to remember that unlike, say, purchasing a stock in the stock market, well, real estate transactions come with significantly more costs that you need to account for. So here are some of the main ones that you need to be aware of, as they can add up honestly to tens and tens of thousands of dollars depending on the size of the transaction. So first and foremost, of course, the down payment, land transfer tax, which is going to be in line with the property's value, notary or legal fees, inspection, potentially mortgage insurance premium and tax if you're getting mortgage insurance premiums on your entire mortgage, potential opening fees depending on the type of lender that you're utilizing, evaluation cost, and then finally settlements between the buyer and the seller. Here's a quick example of a property that I'm personally in the midst of closing on. Actually, by the time this video is out, I probably will have already closed on it, but purchasing this property for $605,000, the down payment on it was 30%, so $181,500, but then all other closing costs combined on this particular property equated to roughly $20,000 in fees between transfer taxes, opening fees on the mortgage, evaluation costs, and so forth. Before buying any property, if possible, I would recommend conducting an inspection on it to uncover any large and unforeseen expenses that could be lying under the surface that you're not able to identify by walking the property yourself without any further inspections done by a professional. And I'm not speaking here about paint, floors, and other things of that nature that again can be identified when walking the property yourself. I'm speaking about larger structural as well as expensive issues that a professional is better suited to identify. So things such as the roof, HVAC systems, the foundation, septic systems, if there is one on the property, all of these are things that should be considered before purchasing a property and could then be negotiated with the seller depending on if there are any issues with either of these elements. Okay, the next point has more to do with investing in a rental property, and that is really understanding the market that you're looking to invest in the first place. And the reason why this is important is because real estate values are highly impacted by the location and environment that they're located in, from an entire state or province all the way down to a specific neighborhood in a given metropolitan area. So really knowing the characteristics of the given market that you're looking to invest in and then niching down on specific investment criteria is going to allow you to much better identify and analyze given investment deals. For example, in my market, I knew exactly where I wanted to buy my primary residence down to the exact specific neighborhood as well as all the given characteristics for the property I was seeking out. So that allowed me to research and fully understand what properties in that area looked like and then basically manifest the property, I guess we could say. But in reality, it was just my brain being fine-tuned to exactly what I was looking for and then being being able to cherry pick those opportunities out of the market. And when it comes to rental properties, the exact same thing holds true. In fact, it's pushed even further. In fact, I only invest in specific areas even of my larger metropolitan market where I know what properties go for, I know what rents go for given sizes of the units, average cap rates, optimization potential, demand for units, population growth, and so forth. Because if you don't know anything about the market that you're looking to invest in the first place, you'll never be able to target what a good deal looks like when it inevitably comes up down the line, and essentially you'll be taking a shot in the dark. This would be no different than purchasing a stock without looking at the company's underlying financials as well as researching the trends for the industry that it operates in. Now, this actually brings me to my next point. If you're new to property investing, then you might not actually be aware of the fact that residential properties as well as smaller multifamily properties such as duplexes, triplexes, and fourplexes are typically valued mainly based on comparable sales in the area. So what do I mean by this? A comparable is quite simply a recently sold property that shares many of the same characteristics as the one that you're looking to either buy or sell, and in the same general area, used for valuation purposes of a similar asset. Because there is a difference between what people are listing properties for versus what they've actually sold for in the market. For example, when looking to purchase a rental property specifically, well, comparables can help you determine what other similar assets have actually sold for in recent history, as well as at what cap rate or revenue multiple, to see whether or not you're paying more or less for a similar asset. So personally, I get my realtor to pull a list of comparable properties when I'm looking to actually buy a value add project so that I can get a ballpark range for what the property would be worth after repairs for when I'm looking to either refinance or sell the property down the line. So bottom line, this is why working with a real estate agent is always going to be the best course of action, regardless of if you're purchasing a rental property or even just your primary residence, and pulling a list of comparables is always going to be a relevant exercise. Speaking of buying a property that has potential based on similar comparables in the area, this brings me to the next point that's especially relevant for first-time buyers, and that would be to buy a fixer-upper property that will be worth much more than what you paid for it, even considering the costs associated to renovations that you'll be bringing to the property. I see people my age, so in their mid-20s, either buying properties that are full-on new constructions, making these homes full-on commodities rather than somewhat of an investment, hopefully, or completely maxing out their credit and debt servicing on a property that's at the top of their budget. The problem with this is that you basically have zero equity built in the property the second that you sign the papers, other than of course your down payment, but that doesn't really count because you put that money out of pocket into the property. And I said this countless times before on the channel, primary residence equity is really the bedrock of wealth and financial independence towards retirement for the average Canadian. So for example, if you're able to buy a property for $300,000, put $75,000 into it in renovations for it to then be worth $500,000, well then right there you've created an equity spread between what it's worth and what you have in the property of, in this case, $125,000. And I know what you're thinking right now, where would I even get these $75,000 for those renovations in the first place? And the answer to that is you get it from a renovation loan. Put 5% down on your primary residence and then request a renovation loan for a large portion of the renovations that you plan on bringing to the property. There you go. I've done it many times over. Now, it's definitely become harder and harder for first-time homebuyers to finally get a foot in the market, which is why utilizing the right tools and strategies is really important in your plan towards saving for your down payment. Luckily though, there are many registered investment accounts as well as other programs both in Canada and the United States that can be used to help save for and buy your first property. Here are a couple examples. So the first-time homebuyer plan in Canada allows buyers to essentially borrow from their RRSPs without incurring any penalties or added fees for the purchase of a home, and then you can pay back that amount over a several year period, right? So most people do have quite a few RRSPs saved up, especially if you're someone who is actually serious about purchasing a house. Chances are you've been in the workforce for several years and have some RRSPs, which can represent a great source of liquidities for you. Otherwise, you could also use other new registered investment vehicles such as the tax-free first home savings account, which is brand new and is kind of like a combination between a tax-free savings account and an RRSP with the purpose of purchasing your first home. And that is a great source of down payment that you can build up over a several year period. And finally, we've pretty much all heard of the concept of time in the market versus timing the market, and this very much applies to buying your first property as well. And if you're a first-time property buyer, then you'll have even less leeway to try and time the market, right? So if you've been saving up for for your first property over the past several years? Well, the last 3 years have made purchasing that first property extremely challenging as asset prices have risen quite a bit. And then now following that, well, even though property prices are diminishing, actual financing costs are going up due to the fact that interest rates have been increasing. So in my opinion, the point to take out of this is that you really cannot time the market. And if you're ready to buy a home right now, then you should do so just purchasing a home that fits within your budget and within your financial means. At the end of the day, you should only be purchasing a primary residence if you do plan on staying in it for at a minimum 3, but hopefully 5 years plus. And ultimately, no one really knows where the market is heading over the next 12 to 24 months, and even less so longer term. What is certain though is that over time, real estate values tend to steadily rise year over year, making properties a fantastic hedge against inflation when held over a long enough period of time. So unless you're buying a property that's completely ridiculous or highly overpriced, typically speaking, a house isn't going to be an investment that most people regret in their life. So bottom line, property ownership really has become the bedrock of financial independence for the average family across Canada and really across North America as a whole. If you want to learn more about real estate investing and home buying tips, then make sure to check out my full real estate investing playlist that you can check out here on the channel. There are many different videos going over various topics about the entire home purchasing process as well as real estate investing. I really hope you enjoyed today's video. If you did, make sure to drop a like. It really helps the channel out, and check out the links down below to resources that I recommend. For example, you can get the best rates with Nesto, the best interest rates that is, and you can lock in your rate for up to 90 days simply by applying online. Also, if you're interested in real estate investing and taking that to the next level, check out my full wealth through real estate investing course that you can check out on Udemy. Once again, a link down below in the description. So on that note, thanks a lot for watching today's video, and I will see you in the next one.